Capital structure techniques in corporate finance. So in this section, we will see what is capital structure, what is debt equity ratio, what is cost of equity and cost of debt, what is cost of capital and weighted average cost of capital or WACC. So first let's examine what is corporate finance in order to understand the different terms involved in that. Corporate finance is financial management that deals with how corporations maximize the wealth for its shareholders by adopting long-term and short-term financial planning, at the same time improving upon business strategies and implementing the right ones, from capital investments to tax strategies. Corporate finance is concerned with how business funds their operations in order to maximize profits and minimize costs. At this juncture, a lot of explanations are required to see how the various strategists and planners achieve this result by constantly working at the capital structure and by adopting an appropriate debt equity ratio and proper leveraging. So what is debt equity ratio? What is leverage? What is capital structure? We will try to explain each of them. So first, what is capital structure? Capital structure is the particular mix of debt and equity used by a company to finance its overall operations, activities, and growth. Debt comes into the company in the form of loans, bonds, or issues, whereas equity comes into the company in the form of common stock, preference stock, or retained earnings. It's a common knowledge that the short-term debt is also considered to be part of capital structure. The nature of debt is in such a way that it is borrowed money that is due back to its lender with an expense, which is the monthly interest with which the company has to pay to its lenders. The nature of equity consists of ownership rights in the company, and hence the money need not be given to the owners because it is shared ownership rights in the company. Both debt and equity is found in the company's balance sheet. In addition, there exist assets in the company's balance sheet which can be bought with debt or equity. Ownership money or equity which is used to buy company assets is termed capital, whereas lenders' money, debt, when used for such a purchase may lead to short-term debt and long-term debt for the company. Hence, in other words, capital structure can be a mixture of a company's common stock, preference stock, which are both equities, short-term debt and long-term debt, which are both debts. Now, what is debt equity ratio? That is what we are going to examine. Debt equity ratio and leverage. When analysts or financial experts refer to capital structure, they indirectly refer to a company's debt equity ratio and gauges how risky it is for investors or lenders to be investing or lending money to the company. Normally, a company which is heavily financed by debt is definitely riskier and has a more aggressive capital structure. Usually, a company that is financed by equity has a low leverage and is moderate or low risky for investors or lenders. Nevertheless, a company raises money by taking debt from the capital market and is in general advantageous for the company because the interest payments on debt is usually tax deductible and it allows the company to retain ownership rights, unlike in the case of equity financing. At times of low interest rates, debt is easily found and equity may be a lot more expensive. However, in equity financing, money need not be paid back to the investor as he is given an ownership right on the company and its future earnings. Debt equity ratio is the ratio of debt to equity, and this proportion is for the total assets of a company. Now let us see what is given in the diagram. Companies that use more debt, which is shown on the left-hand side of the diagram, companies that use more debt to finance their operation and activities is said to have a high leverage ratio as opposed to companies that uses less debt, to finance their operation, which is shown on the right side of the diagram. One of the goals of the company is to find an optimum capital structure, which is the right combination of debt and equity in its capital structure. Firms in different industries use different capital structure. Ones in the information technology industry may have utilized more equity, whereas automakers may have utilized more debt. Now, what is cost of equity and cost of debt? Cost of equity is the return demanded by its shareholders, whereas cost of capital would mean the cost that a company must pay in order for it to raise new capital funds. In other words, a company's cost of equity is the compensation that the financial markets require in order for them to own the assets of a company, as well as take the ownership of the risk associated with such assets. There are generally two ways to calculate cost of equity. One way is by CAPM or capital asset pricing model, and the other way is by dividend capitalization model. In CAPM or capital asset pricing model, in order to calculate cost of equity, a company's beta is multiplied by its market risk premium and is then added to the risk-free rate. In dividend capitalization model, cost of equity is equal to dividends per share divided by current stock price, which is added to dividend growth rate. Cost of debt is the interest that a company may end up paying for its debts, such as bonds or issues or loans. It may also refer to before tax as well as after tax cost of debt. The main difference is that cost of debt before and after tax may be differentiated on the basis of the statement that interest expenses are mostly tax deductible. Now let us see what is cost of capital and WACC. We'll only go through explanations or definitions of the same. Cost of capital and WACC. Managers decide on capital structure by taking into consideration cost of capital and taking steps to minimize this metric. So what exactly is cost of capital? Cost of capital is the way a company calculates minimum return necessary so that it may take up a capital budgeting project like building factories or plants. Hence, investors and analysts may indicate an evaluation of an investment's potential return while using this term in the light of its costs and risk. Companies who may use debt and equity to finance its operations in general may have a lot of sources of funds, and hence they may assign a specific weightage to each of these sources. In a cumulative way, it may also be represented as weighted average cost of capital or WACC, WACC. Hence, WACC is the firm's average cost of capital from all sources, including bonds and issues, which are debt, as well as common stock and preferred stock, which may be equity. Thank you.